Hello everybody, Professor Barth here, Associate Professor of History at Arizona State University. Welcome to the Dollar Report. Wow, a lot to talk about. Today, some big events. Of course, as you all have seen, global sell-off in the stock markets, the Dow in Japan and the UK, Europe, all over the board. Really bad news for stocks. We're going to take a look at that today, and Federal Reserve policy, what this means for for interest rates going forward and so on. What's really interesting about the sell-off is it comes right on the heels of the FOMC meeting, or Federal Open Market Committee meeting last Wednesday. The Fed elected to keep rates at the same level they've been for the last year, over a year, actually. And the federal funds rate, the upper limit is 5.5%, lower limit is 5.25%. They've decided to keep it the same. They've received a lot of scrutiny for that. And since then, it's been bad news. On Friday, very weak employment numbers. Job growth was very weak. The unemployment rate, while still low, rose to its highest level since 2021. And then monthly job creation was much lower than expected. And of course, today, global market sell-off. Beginning with Japan, the Nikkei index is down, fell 12% in the last 24 hours, which is the largest crash since 1987. And if you extend it back to the last 5 days, since the beginning of the month, so basically since the last FOMC meeting, the Nikkei index is down 20%. 20%, huge sell-off. In our country, the Dow Jones Industrial Average is down 6% since August 1st. Of course, a rough day today. Right now, it's about just past noontime, in Arizona. It's down about 1,000 points today. But if you look since the last FOMC meeting, the Dow Jones is down 6%. The Nasdaq is down 8.5%. Tech shares are doing poorly. Apple is down almost 6% just today. Tesla is down 4.5%. The S&P 500 since August 1st is down 7%. The FTSE 100 index in the UK is down 5%. And so there's a lot of talk right now. Should the Fed jump in and do an emergency rate cut? Because the next FOMC meeting is not until September 18th. That's well over a month from now. Can the Fed wait before it cuts rates? And so that's the big question. Some people are saying they need to have an emergency meeting. This gentleman here, Professor Wharton, says that they need to cut rates by 75 basis points, or 0.75%, which would be a historic cut. Others are saying no, it needs to be at least 50 basis points, half a percentage point, at either the next meeting or during an emergency meeting. So all eyes are on Jerome Powell. What's he going to do? And I think it's pretty clear at this point, at the bare minimum, at the September meeting, there will be a rate cut, probably 50 basis points. But who knows? I mean, what's going to happen? Is this sell-off going to continue, or is this just a brief panic and things rebound? My strong suspicion, I think the data backs this up, is that this is the beginning of a pretty major correction. Now, why has Jerome Powell not cut rates earlier? Well, if you take a look at the inflation numbers, inflation is still too high. Now, we're going to have new inflation numbers next week, a week from this Wednesday. But the CPI is still year over year, is still at 3%. Now, the Fed uses a different inflation index called the PCE price index. And according to the PCE price index, inflation is at 2.5%, but the Fed's target rate is 2%. And if you look at core year over year inflation, remember core does not factor in food and energy, which tend to be more volatile. Core CPI is over 3%. And then month over month, core CPI is still pretty high. And so the Fed has not moved. And the Dow, notwithstanding today's sell-off, is still up 25% since the beginning of 2021, when the present administration took office. So the Dow has been doing quite swimmingly. It was over 40,000 not so long ago. Unemployment has been low. It was under 4% for a long time. Now, when the FOMC met last week, they didn't have the latest numbers. The latest numbers at that point had come out in June. It was 4.1%. Now it's 4.3%. Still historically low. And so when the FOMC released its statement last week, before all this, the current mess that we find ourselves in today, the FOMC said this: recent indicators suggest that economic activity has continued to expand at a solid pace. Job gains have moderated and the unemployment rate has moved up but remains low. Inflation has eased over the past year but remains somewhat elevated. In recent months, there has been some further progress toward the committee's 2% inflation objective. In support of its goals, the committee decided to maintain the target rate for the federal funds rate, or target range for the federal funds rate, at 5.25% to 5.5%. The committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. And here's the great gamble that the Fed and Chairman Powell are facing. Do they cut rates? Well, it seems like the consensus is now they have to. How do you do that without causing inflation to shoot right back up? Think like a beach ball in the ocean, and you're holding it down, and you let go, and it goes right back up again. This happened in the 1970s with the Fed chair Arthur Burns. He hiked rates, inflation went down, and so he lowered rates, and inflation went right back up again. This was Powell at a press conference last week. We do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably towards 2%. In other words, they don't yet have that confidence that inflation has moved down to that target level. Well, now with the economic conundrum that we find ourselves in, they're going to cut rates. Here's another quote from Powell at his press conference last week. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. Well, there's the key. If the economy remains solid. If the labor market were to weaken unexpectedly, or if the stock market were to crash, or inflation were to fall more quickly than anticipated, we are prepared to respond. And so the broad sense of the committee, Powell said last week, is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. So everyone figured, all right, probably at the September meeting they'll reduce the target range by a quarter. Now it's definitely looking like it's going to be more than that, and maybe there might even be emergency intervention. Elon Musk yesterday said this: the Fed needs to drop rates. They have been foolish not to have done so already. And this again goes back to the problem. I feel like I'm being a dead horse sometimes, but the whole idea of the Federal Reserve is so unsound from an economic perspective. The idea that you can have this Chairman Powell, and as the head of this government-sanctioned private banking cartel, he knows exactly what the interest rate ought to be for the country, and this secretive board that's not audited has these, they release their minutes or whatever, but the meetings aren't audited. They come up with this these policy with monetary policy How do they come up with it? It seems a bit arbitrary sometimes. How do they know what the correct interest rate is? It just violates everything we know about how market economics ought to work. If you haven't read Friedrich Hayek and what he's had to say about the knowledge problem, these bureaucrats, these central planners, and that's what the Federal Reserve is. The Federal Reserve is a central planning agency, and it's not really even a federal agency. We've talked about this in other videos. It is quite literally a banking cartel. It's just sanctioned by the government through the Federal Reserve Act. But the idea that the Federal Reserve is a central planning organization, and all eyes are on Powell. Everyone's just clutching to every word that Powell says at these conferences, and everyone's waiting. What's Powell going to do? That's not how a market economy ought to function, but that's how ours functions. And so you get questions like this: did he make the right decision? Did he not make the right decision? We have a messed up monetary system. I'll leave it at that. We look at this question in some of my other videos. If you're curious about what I think about monetary policy and the Federal Reserve, I've got a whole library of videos you can check out. Now, the one thing that the Fed has done in the last few months is it's continued to reduce its balance sheet. Here's where we currently are. We're basically where we were right after the initial COVID stimulus. So there's COVID, the pandemic, and you'll remember the Fed injected just massive QE right at the outset, and then had persistent QE month to month all the way up through early 2022. I have videos from late 2021, like, why is the Fed still doing QE? This is a disaster. It's going to lead to inflation. Sure enough, it did. And so the Fed has been tightening ever so gradually since 2022. Here's that zoomed in. Since January 2022, the Fed's balance sheet, its assets, has gone down by 20%. How? Well, through a program called quantitative tightening, where the Fed owns these securities, treasury securities, but also mortgage-backed securities. And when those securities mature, ordinarily the Fed will repurchase them. But instead, with quantitative tightening, the Fed allows those securities to run off its balance sheet after they mature. And this is called quantitative tightening. Well, prior to this summer, the Fed, since 2022, allowed for $95 billion worth of securities to roll off or to run off its balance sheet every month. In May, the FOMC announced that beginning in June, so it's past June, that number would be reduced to $60 billion a month. And the reduction was solely in treasuries, not in mortgage-backed securities. That is the only policy change meaningful policy change that we've seen from the FOMC really this year or since the last summer. You zoom out at the federal funds rate and look at this. This is from 2000. I was in high school back then. Seems like ages ago. I suppose I was in 10th grade. Since 2000, here's the federal funds rate. And here we are, sitting right there. You'll notice something. I saw this on Market Watch, this graph. In the gray, you see recessions. Okay? What do you notice? Every recession followed a peak in the federal funds rate. There you have a peak in the 80s, and then you have a sell-off. Peak in the late 90s, dot-com bubble, burst. Peak in the late 2000s in the federal funds rate, housing market collapses. Peak, this doesn't really count as much, I think. This was during the Trump administration, when Powell began to raise rates a bit after basically 0% interest rates for 7-8 years. Powell began to raise rates slightly. We had a recession there. That was an artificial one due to COVID. But here we have the latest one. Is there any doubt that we're going to have a correction? I mean, come on. It's coming. I mean, you can look at it. It's coming. I mean, the chickens are going to come home to roost. So the question is when, and in predicting is always a problem. You know, you can't predict this stuff. Look at this is I was looking at some of my old PowerPoint slides from dollar reports last year. This is the FOMC minutes from June of 2023. So last summer, this is what the FOMC was saying. This was their economic forecast that they came up with in June 2023. They said that, well, given the tightening that we've had in credit, their forecast was that there would be a mild recession starting later this year, meaning 2023, last year. A mild recession followed by a moderately paced recovery. The unemployment rate was forecast, this is the quote, I should put an end quote there. The unemployment rate was forecast to increase this year, 2023, peak next year, that's our current year, 2024, and remain near that level through 2025. Obviously didn't happen, and actually you look at the forecasters for Goldman Sachs and all the, back in 2023, they thought the recession was going to come a year ago or 9 months ago. I thought that too. I was saying, you know, we knew something was going to happen. We knew the correction was coming. The question is when. And so you can't predict markets. Markets are so unpredictable. But it's coming. And boy, it sure looks like this might be it. Okay? It just looks like this might be it. There's the future meetings this calendar year for the FOMC. Again, we'll have one September 18th, November 7th, December 18th. Gold's holding steady. Gold is the ultimate safe haven asset. And if you look at how gold has performed since the beginning of 2021, it's up 34%. It's performed better than the Dow, even prior to today's sell-off. Gold is performing since 2021 better than the Dow. And then if you look at just this calendar year, gold is up 24% for the calendar year. That's pretty good. The Dow is up 3% for the calendar year. I tell people, you need a diverse portfolio, but gold, it's been around for thousands of years. It's going to continue to be around as long as this world's around. Gold is, it's the ultimate safe haven asset. Silver's been, I'd say, a bit disappointing over the last few years. It's up 11% since 2021. This calendar year, silver's up 20%. And actually, it was 32.5 earlier this summer. So gold and silver, safe haven assets. Bitcoin's getting a really bad rap today. Everyone just loves to hate on Bitcoin. And look, Bitcoin is volatile. Look at this chart. I mean, obviously, Bitcoin is very volatile. This is from early 2021, January of 2021 to today. It's not gold. It's not the ultimate safe haven asset. Also, don't day trade Bitcoin either. It's risk. It's a risky thing. But for all the hate Bitcoin gets, it's up 43% over the last 3.5 years. That's pretty good. That's outperforming the Dow and outperforming gold for that matter. And then even this calendar year, just from January of this year, Bitcoin is still up 23%. Yeah, it's had a rough few days, but at $53,000, I think everyone just loves it. Everyone loves a rag on Bitcoin, and they prophesy the end of Bitcoin. Bitcoin's done. It's finished. It's going to crater, and it just never happens. And I think a lot of this is just people, for whatever reason, want Bitcoin to fail, and so when it has a bad few days, people just like, but the data doesn't back it up. So don't put all your investments in Bitcoin. Please don't do that. But I still think Bitcoin's a good investment. So that's where we are. Inflation is still high enough to where if the Fed really begins to slash rates, as it appears they will, you have a real risk of it coming back up. Just from an electoral standpoint, I mean, we have an election coming in November, so lots riding on what happens with the economy between now and November. And of course, we have early voting. Some early voting begins next month. But inflation under this administration, Biden-Harris, and it's fair to call it that, total prices, I did the math. I looked at, you look at the data. Total prices under this administration are up 20% over the last 3.5 years. Hourly earnings are also up, but they're only up 16.5%, which means real earnings are down. Ordinary Americans are struggling under this administration. That's going to hurt Harris at the ballot box, especially if this sell-off continues and we really do enter into a real recession. Compare this to Trump's numbers. Under Trump, total prices went up 8%. Average hourly earnings went up 15%. So you have a real increase there, a nominal increase that's higher than the rate of inflation, so a real increase. Now, to be clear, the White House isn't in charge of monetary policy. They're in charge of a lot, including regulatory policy, and they set the agenda, so it does have an impact on the inflation rates. However, it's the Fed. It's the Federal Reserve that's in charge. Nevertheless, I think from a political standpoint, this will hurt Harris, and if this economy continues to, if the sell-off continues, it's undoubtedly going to hurt Harris. People are struggling. Look at the bank prime loan rate, which follows the federal funds rate. It's the highest it's been since the early 2000s. So we're talking over 20 years. Borrowing money it's expensive. And then you look at the mortgage markets, and they've been steady over the last year and a half or so. But you zoom out since 2002, and Americans got really hooked on low mortgage rates, and we've had to adjust to high mortgage rates plus a housing market, housing prices that are just completely off the charts. So Americans are hurting, and not good news today in the markets. Saw this coming, and who knows, maybe things will rebound, and then you just have to wonder, at what point is the correction coming? But there's got to be a correction. There's going to be a correction. All this debt, something's going to happen. So anyway, thank you. It's been several months since I made a dollar report. Just things seem to be in a lull economically. There's inflation had sort of tapered off at around 3 to 4%. And the economy is just kind of going along. There wasn't much to report on, but definitely things are moving today. Thought it would be good to have a report. Also, I've been doing my John Locke series. Just finished that, so if you haven't seen the John Locke lecture series, go do that. And I've got a baby boy coming, Constantine. He's going to be here any day. Could be born tonight, this week, next week. We'll see. We're going to do a home birth. We had our last daughter at home, and it went really well. So this was him. This was Constantine at like 16 weeks or something, 18 weeks. He's at 38 weeks now. So Just waiting. Anyway, all right. Hope y'all are good. Anything big happens, I'll come in with another update. Till then, see you.